Hi, it's Professor Mike, and we're going to be talking about cash and financial instruments. You would think cash is, you know, the critical that matter. No, it's not. In today's age, you don't keep mountains of cash lying around, and so it's a fairly straightforward audit area. It is important to do, but it will very likely never be critical. It should be simple, but apparently it was beyond the skill set of PricewaterhouseCoopers in India because they failed to confirm appropriately third-party cash. They didn't keep the custody of the confirmations outside of the company, so those got manipulated. And Satyam, a large outsourced consulting firm, managed to conduct a massive fraud where they said they had $1 billion in cash that they didn't really have. So yeah, this should be a fairly straightforward audit area, but it does require you to pay attention. So the major cash accounts are, general accounts, um, you know, the bank account and financial instruments. You as an auditor don't care about petty cash. You care about cash, cash equivalents, um, and anything that's kind of a structured cash account. So what you're going to see in a lot of bank accounts, this is not on this slide, but what you're going to see in a lot of bank accounts in Silicon Valley is what's called the ZBA, or a zero balance account. Essentially, that's the account where they make payments and receive payments, and it's the account that goes to the outside world. Meanwhile, in the background, you have a money market or some type of small interest bearing but very liquid cash account. And every night, the bank automatically looks at the balance in the ZBA account and it sets it to zero by transferring money to or from the money market account, right? So, in other words, you have a shell account where payments come in and out, and at the end of the night, whatever balance is in there either gets transferred to the general checking account or transferred. There's a transfer in to cover the negative balance. That's why it's called a zero balance account. You will see those all the time. Um, Payroll you're not going to have in most cases. Petty cash, nobody cares about. You round the financial statements to thousands or millions. So if you got a couple $100 in petty cash, um, that's a challenge. So be careful on your exam because I could ask you an audit question about petty cash, and if you say if you apply audit procedures to petty cash, you're going to lose points because you know it's not material. Okay, so cash is ultimately involved in almost every transaction cycle except allocations, right? So whether you're dealing with accounts receivable, sales revenue, um, purchases, all those things ultimately go through cash. There's no way around it. So you want to understand cash, and the book puts it at the end, but I really like it more at the beginning of the audit chapters because it is the anchor for all the transaction flows. Um, so, you need to look at the bank reconciliation and then also the transactions that underlie the bank reconciliation. So, the bank reconciliation is a balance per bank um, with outstanding items being identified, things that are either in transit or checks that haven't cleared, and then a final balance that is in your general ledger, right? So checks that haven't cleared are still liabilities to you because they're showing in your bank balance, but they haven't cleared, and so they are reducing your cash balance on your GL. So they're like a search for unrecorded liabilities. Um, and the deposits in transit, it can take a few days, especially if you're a company that accepts a lot of credit card payments. Usually, credit card companies will hold payments for 2 to 3 days before remitting them to you, and so you will see will see either cash in transit or receivable account potentially, but quite often those will get recorded in cash. So it's relatively easy to verify the reconciliation balances to the general ledger, but you got to confirm with the bank. Um, and so you can see, again, here's a diagram of all the things that hit the cash cycle. So, basically, again, last audit area that you'll see this in, but it's you look at the business risks affecting cash, you set a materiality level, you assess control risk. Quite often, control risk might be low to moderate because you've assessed internal controls other places, and reviewing a couple bank reconciliations can also get you significant control assurance. So, and then you design and perform your test of controls. Looking at bank reconciliations, maybe looking at transactions throughout the year, including major funds transfers, who signs checks, all that kind of stuff. And another point, a lot of the textbook will talk about checks and paper, and we're in a wire transfer world. I got mad at Zynga because people would still be writing checks, and I forced everybody to go completely paperless. So you had to present your invoice paperlessly, and you had to receive a wire. Otherwise, you didn't get paid. That way, I wasn't signing checks. We weren't dealing with checks because checks cost a lot of money to do. So, the three procedures that are important are receive the bank confirmation. You want to send that directly to the bank and then receive it directly from the bank. And again, all this will be done electronically. Looking at cutoff bank activity after year end, like the search for unrecorded liabilities, you look at checks that cleared after year end to see if they should have been on the bank reconciliation for the December 31st. So you can see the different types of audit tests and where you're doing tests of controls versus substantive audit procedures versus substantive test of transactions. There is the possibility of fraud with cash, but and there's quite a few slides on this. But the fraud with cash is more rampant actually in things like nonprofits, churches, charitable organizations. Unfortunately, people have easy access to funds in banks, and they're able to create fictitious things and take money because there's a lot more control and trust in a not-for-profit enterprise. There just is. And there are bad people. So if you're doing a not-for-profit, you should spend some attention to this because they're not as focused on internal controls. A larger company is going to be focused on internal controls. It doesn't necessarily mean that they can't be subject to fraud, but they are more aware of it and more willing to invest in controls. So there's different ways to do this, including looking at the GL for unusual items, looking at orders to receipts. I don't think we'd ever do a proof of cash in today's world, which is basically look at all the transactions unless there is evidence of fraud. But a proof of cash would be beginning balance, all the transactions, both debits and credits, and verifying those and ending cash. It's very, very detailed. But tests of interbank transfers you will do because you want to make sure that transfers within the banks, especially with entities that have foreign affiliates, right? You have to move money from the U.S. to your foreign affiliate or vice versa. You need to make sure that both sides of those transfers are recorded on the same day. They may not hit the bank on the same day, but you want to make sure that they're recorded in the GL because, again, there's consolidation, right? Um, you know, you obviously on investments, it's a little trickier. If they're if they're market-based investments like treasury bills, things like that, it's easy to validate their value. If they are, other types of investments, derivatives and things like that, those present more risk and present more potential for disclosure. So one of the keys here is to understand, like we saw at Lehman Brothers, you need to understand what the underlying asset is. If you've got a derivative that looks really good, but is ultimately backed by subprime mortgages or junk debt from corporations, that's a problem. Even though it looks like just a derivative security, it's not, right. The underlying assets are what are necessary to perform in order to get the money. So this is one area to really spend some time on, and a lot of times on the investment side, you won't see this in the first year unless the companies invest in treasury bills and stuff. One of the key controls around financial instruments is the fact that the board of directors usually sets an investment policy. In a private company, it's their money more often than not that's being used, and so they very much care about the custody of their money. So they will set investment policies, and usually in startup companies, all you care about is liquidity. You're not trying to make you're not there, and the VCs aren't there to have you invest money in treasury bills or securities to make money on that. They want you to build a company that's going to have a much greater return than treasury bills or other stuff. So they'll give you enough money to last for a while, but they also want you to manage liquidity, and so you want to be able to basically put in low risk stuff like treasury bills for them. So again, for investments, same thing. You'll design and perform tested controls and do do substantive procedures. That's it. We're on to chapter 24.